Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about the Cheesecake Factory Incorporated annual report. The Cheesecake Factory Incorporated offers a diverse range of businesses and services through its various brands. At the core of its operations are its restaurants, which operate under 4 distinct brands: the Cheesecake Factory, North Italia, Flower Child, and Fox Restaurant Concepts. These establishments provide dining experiences to customers in the United States and Canada. In addition to its restaurant business, the company operates bakeries that produce a variety of baked products, including cheesecakes, for both internal use and external sale. Its bakery products are supplied to international licensees, third-party bakery customers, external food service operators, retailers, and distributors. This indicates that the company's services extend beyond just its restaurants, encompassing a broader range of businesses and industries. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to increase. The Cheesecake Factory Inc.'s stock price has seen an upward trend in the past year due to several factors. One of the primary reasons is the company's consistent revenue growth. The Cheesecake Factory has been able to maintain its market share and expand its customer base, leading to increased sales and profits. This growth has not only boosted investor confidence, but also led to a rise in stock price. Another factor contributing to the increase in stock price is the company's strategic expansion plans. The Cheesecake Factory has been actively expanding its operations, both domestically and internationally, which has helped to increase brand visibility and attract new customers. This expansion has also created opportunities for the company to diversify its revenue streams, further solidifying its position in the market. Additionally, the company's focus on innovation and customer experience has paid off. The Cheesecake Factory has been investing heavily in digital transformation, enhancing its online ordering and delivery capabilities, which has helped to increase customer satisfaction and loyalty. This commitment to innovation has not only driven growth, but also attracted new investors who are looking for companies with a strong track record of innovation. Overall, the combination of revenue growth, strategic expansion, and focus on innovation have all contributed to the increase in the Cheesecake Factory Inc.'s stock price over the past year. The Cheesecake Factory Incorporated maintains a market capitalization of $3 billion, broadly in line with the industry peer group. The Cheesecake Factory Incorporated trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 7.28 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 87% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for the Cheesecake Factory can be summarized into several key areas. On the positive side, an increase in total operating weeks, menu price increases, and comparable sales growth have contributed to revenue growth for certain brands such as North Italia and Flower Child. However, on the negative side, decreased customer traffic, a negative impact from mix, commodity and wage inflation, geopolitical and macroeconomic events, and supply chain challenges have all contributed to revenue decline. Additionally, gift card activity has also been affected, with a slight decrease in gift card activations and an increase in gift card redemptions and breakage. In terms of financial performance, net income has decreased slightly, while estimated future revenues have increased significantly. Overall, the company's revenue growth or decline is influenced by a complex interplay of factors that require careful management to mitigate potential risks and capitalize on opportunities for growth. The net income of the company experienced a mixed trend between 2024 and 2025. On one hand, it decreased from $156.8 million to $148.4 million, indicating a decline of $8,356. However, when considering the overall change, the net income actually increased by $33 million. The decrease in net income can be attributed to impairment charges for long-lived assets, which reduced the net income by $23 million. The profit margins also underwent changes during this period. While the EBITDA margin decreased by 0.1%, the adjusted EBITDA margin increased by 7.6%. This indicates that despite a slight decrease in overall profitability, the company's ability to generate cash from operations improved significantly. The net income margin, however, decreased from 4.38% to 3.96%, suggesting a decline in the company's efficiency. The reasons behind these changes are multifaceted. High inflation and price increases led to higher costs for the company, while tariffs, regulatory changes, and commodity price fluctuations further exacerbated the situation. Additionally, impairment charges for long-lived assets and an increase in advertising costs in fiscal 2025 contributed to the decline in net income and profit margins. The company's operating cash flow has been steadily increasing over the past 3 years. In 2023, it stood at $218 million, which rose to $268 million in 2024, and further increased to $301 million in 2025. This upward trend indicates a significant improvement in the company's ability to generate cash from its core operations. The increase of $33 million between 2024 and 2025 is particularly noteworthy, demonstrating that the company's efforts to optimize its operating efficiency are yielding positive results. Overall, the data suggests that the company is successfully generating positive operating cash flow, which is a key indicator of financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, the debt level increased significantly compared to historical levels, with a notable increase of approximately $276 million in 2025 due to the repurchase of 2026 notes. This resulted in a current debt of $644 million, up from the previous year. Furthermore, long-term debt and total liabilities also saw an increase, rising from $452,062 in 2024 to $561,259 in 2025, and from $2,598,305 to $2,825,245, respectively. However, by December 30, 2025, the company reported no outstanding debt balance. This suggests that the company has made efforts to reduce its debt level. In terms of interest expenses, there are some inconsistencies in reporting across different pages. Nevertheless, it appears that interest expense, net, increased from $10,107 in 2024 to $10,448 in 2025, indicating a rise in interest expenses. However, the company also reported a decrease in interest expenses from $12,891 in 2024 to $8,682 in 2025, suggesting some fluctuations in this metric. Management is optimistic about the company's future prospects, with plans to leverage its competitive strengths to expand the Cheesecake Factory brand and increase market share. A key goal is to grow earnings while expanding the number of company-owned restaurants domestically, targeting 300 locations over time. Internationally, management is exploring opportunities for direct operation, licensing, joint ventures, and partnerships to expand North Italia and Flower Child brands. This strategic expansion aims to drive revenue growth through new openings and comparable sales increases. To support these initiatives, management plans to invest in new restaurant development, prioritize financial flexibility, and maintain a strong balance sheet. The company also expects to generate significant cash flows from operating activities, with a notable increase in cash provided by operating activities from $218,401 in 2023 to $301,281 in 2025. Management's strategy is focused on driving growth while managing risks associated with commodity price fluctuations through hedging vehicles and contract negotiations. The company's strong liquidity position, with net availability for borrowings of $366.5 million as of December 30, 2025, provides a solid foundation for these initiatives. Overall, management's outlook is positive, with a focus on expanding the business while maintaining financial stability. The acquisitions made by the company include the purchase of North Italia, Flower Child, and the remainder of Fox Restaurant Concepts business. Additionally, a subsidiary of Fox Restaurant Concepts was also acquired, although specific details regarding the date and cost of this acquisition are not provided. In terms of divestitures, the company has closed several locations across its various brands. This includes 2 Grand Lux cafes, 4 The Cheesecake Factory restaurants, including 2 relocations, 1 Flower Child location, 1 Social Monk location, and 1 other Fox Restaurant Concepts location. Furthermore, North Italia was also closed in fiscal 2026, marking a significant divestiture for the company. The company's financial activities have been marked by 2 significant actions: paying dividends to its shareholders and buying back shares from the market. On the dividend front, the company has indeed paid out dividends, with multiple pages in the report confirming this practice. In terms of share buybacks, the company has also been active in this area. Specifically, it has repurchased a total of 59.9 million shares at a cost of $1,983.6 million. This indicates that the company is committed to returning value to its shareholders through both dividend payments and strategic share purchases. Concerns about inventory buildup and supply chain disruption are evident throughout the extracted summaries. On page 11, maintaining restaurant-level inventories at a minimum dollar level raises concerns about inventory buildup. This is further exacerbated by supply chain challenges caused by geopolitical and macroeconomic events on page 15. Supply chain disruption is mentioned multiple times as a concern, with volatility in cost of products and services used in operations being a significant issue, page 20. The vulnerability of third-party vendor systems to various risks also poses a threat to the supply chain, page 22. The potential for future disruptions due to geopolitical and macroeconomic events is highlighted on page 40. A write-down of gift card inventory in fiscal 2025 indicates potential issues with inventory management, suggesting that inventory buildup may be a recurring problem, page 44. The decrease in inventory levels contributing to increased cash flows from operations on page 47 does not provide further insight into the issue. Purchase obligations and real estate obligations are mentioned as concerns on page 49. Supply chain disruption is again highlighted due to geopolitical and macroeconomic events, causing supply chain challenges and increased commodity and wage inflation, page 68. Overall, these findings suggest that inventory buildup and supply chain disruption are significant concerns that need to be addressed. That concludes the financial summary for the Cheesecake Factory Incorporated. Feel free to comment below, and I will be happy to answer them when possible.